What if I told you that a new wave of inflation is forcing central banks into a corner, threatening homeowners, borrowers and entire economies on both sides of the Atlantic? While the Eurozone has just raised interest rates from 2.15 to 2.4%, inflation in the United States has surged to a shocking 4.2%, and the United Kingdom may be heading toward an even bigger financial squeeze. The next few weeks could determine whether borrowing costs continue to climb, mortgage payments explode higher, and currencies face even greater pressure. In this video, I will break down what's happening in the Eurozone, the United States and the United Kingdom, and why millions of families could soon feel the impact in their daily lives. The European Central Bank's decision to raise interest rates from 2.15 to 2.4 did not happen in vacuum. Across the Eurozone, inflation remains a serious concern, with some of the weakest member economies experiencing price growth approaching 7%. In countries such as Croatia and Greece, inflation remains above 5%, putting significant pressure on households and businesses as the cost of living continues to rise. Even in some of the European zone's strongest economies, inflation is still running at elevated levels. The Netherlands, Belgium and Ireland are all experiencing inflation of around 4%, a level that remains well above the ECB's long-term target. When inflation stays this high for an extended period, the purchasing power of the currency gradually erodes. In simple terms, every euro buys less than it did before, reducing the real value of savings and increasing costs across the economy. This is exactly why the European Central Bank has chosen to tighten monetary policy and raise interest rates. By increasing borrowing costs, the ECB hopes to slow demand, reduce inflationary pressures and strengthen confidence in the euro. However, this move could create additional pressure for other major currencies. Before this latest ECB rate hike, interest rates in both the United States and the United Kingdom were already significantly higher than those in Eurozone. Despite those higher rates, inflation in both countries remains stubbornly elevated, hovering around the 4% range. Now that the ECB has begun pushing rates higher once again, the relative attractiveness of the euro could increase in global financial markets. That development may place additional pressure on both the US dollar and the British pound, particularly if investors begin expecting further ECB tightening. As a result, policymakers in Washington and London may soon face growing pressure to respond. If inflation remains elevated and energy prices continue to fuel price increases, both the Federal Reserve and the Bank of England could be forced to consider additional interest rate hikes in the weeks ahead. The battle against inflation is far from over, and the central banks across the Western world may be entering a new phase of monetary tightening. But what happens if the US and the UK refuse to raise rates? A crucial question now facing financial markets is this: what happens if inflation remains high in the United States and the United Kingdom, but their central banks decide not to raise interest rates further? In this scenario, both the US dollar and the British pound could come under increasing pressure against the euro. Investors are constantly searching for the best combination of return and stability. If the European Central Bank continues raising interest rates while the Federal Reserve and the Bank of England remain on hold, euro-denominated assets could become increasingly attractive to global investors. As more capital flows into the Eurozone, demand for euros could rise, strengthening the currency relative to both the dollar and the pound. At the same time, persistently high inflation would continue to erode the purchasing power of consumers in the United States and the United Kingdom. This combination of high inflation and unchanged interest rates could create doubts about whether policymakers are doing enough to defend the value of their currency. Currency markets often react quickly when they believe a central bank is falling behind the inflation curve. If inflation continues creeping higher while interest rates remain unchanged, investors may begin moving capital toward economies that are taking more aggressive action against rising prices. For the British pound, the situation could become especially challenging. The United Kingdom already faces a difficult combination of elevated inflation, slower economic growth, and concerns about currency weakness. If the euro continues strengthening while the Bank of England remains on the sidelines, the pound could lose further ground against the European currency. A weaker pound would make imported goods more expensive, potentially creating even more inflationary pressure inside the British economy. The United States could face similar concerns. Although the dollar remains the world's dominant reserve currency, investors still pay close attention to interest rate differentials and inflation trends. If inflation remains stuck above target and the Federal Reserve refuses to respond, markets could begin questioning whether real returns on the dollar-denominated assets are becoming less attractive. This would not necessarily trigger a sudden collapse of the dollar, but it could gradually weaken the currency against a strengthening euro. The result would be a difficult dilemma for both Washington and London. Either they accept a weaker currencies and the risk of prolonged inflation, or they eventually raise interest rates further to defend purchasing power and maintain investor confidence. This is why many analysts believe that if inflation remains elevated and the ECB continues tightening policy, additional rate hikes in both the United States and the United Kingdom could become increasingly difficult to avoid. Why the British pound could face an even greater risk than the dollar? While both the US dollar and the British pound could come under pressure if inflation remains elevated and interest rates fail to keep pace, the risks facing the United Kingdom may be significantly greater. The reason is simple: the pound does not enjoy the same global status as the US dollar. The dollar remains the world's dominant reserve currency and is deeply embedded in international trade, commodity markets, financial contracts, and central bank reserves. Even when investors become concerned about inflation or monetary policy in the United States, the dollar continues to benefit from its unique position at the center of the global financial system. The British pound operates under very different conditions. Although it remains one of the world's major currencies and continues to play an important role in global finance, its share of international reserves and global transactions is far smaller than that of the US dollar and significantly below the combined influence of the euro area. Because of this, confidence becomes even more important for the pound. If inflation in the United Kingdom remains stubbornly high while the Bank of England refuses to raise interest rates, investors may begin questioning whether the sterling-denominated assets are providing sufficient protection against rising prices. In such an environment, global capital could begin flowing toward currencies offering either stronger anti-inflation policies or larger economic backing. A strengthening euro supported by higher ECB interest rates could become one destination for the capital. The US dollar, despite facing its own inflation challenges, could remain another destination due to the enormous size and liquidity of American financial markets. Even the Chinese yuan could continue attracting greater international attention as China expands its role in global trade and financial agreements. The danger for the pound is not necessarily a single dramatic event. Instead, the greater risk is gradual erosion of confidence. Central banks around the world collectively hold hundreds of billions billions of dollars worth of reserve assets. These institutions constantly evaluate the balance between risk, return, stability, and long-term purchasing power. If policymakers around the world conclude that inflation is weakening the pound while the Bank of England is not responding aggressively enough, some reserve managers may choose to slowly reduce their exposure to sterling assets. The same logic applies to pension funds, sovereign wealth funds, multinational corporations, and international investors. Even relatively small reallocations can create meaningful pressure when they occur across many institutions simultaneously. As demand for pounds declines, the currency could weaken further. A weaker pound would increase the cost of imports, particularly energy, raw materials, industrial inputs, and consumer goods purchased from abroad. Those higher import costs could then feed directly back into domestic inflation, creating a dangerous cycle in which currency weakens generates more inflation, and more inflation generates additional currency weakness. This is one of the scenarios that the central banks work hard to avoid. The situation becomes even more complicated when compared with the euro. If the European Central Bank continues raising interest rates while the Bank of England remains on the hold, the interest rate gap could increasingly favor euro-denominated investments. Investors seeking higher returns may find European bonds, saving products, and other financial instruments more attractive than comparable assets in the United Kingdom. As a result, the euro could continue strengthening against sterling. A sustained appreciation of the euro relative to the pound would not only affect foreign exchange markets but could also influence trade flows, investment decisions, and international perceptions regarding the long-term stability of both currencies. Over time, perception matters enormously in currency markets. Currency derive value not only from economic fundamentals but also from confidence. When confidence strengthens, investors are willing to hold assets denominated in that currency for long periods. When confidence weakens, capital often searches for alternatives. For the United Kingdom, maintaining credibility in the fight against inflation may therefore become one of the most important challenges facing policymakers over the coming years. Some analysts argue that if inflation remains elevated and the Bank of England refuses to tighten policy while other major central banks continue acting aggressively, the pound could face a prolonged period of weakness against both the euro and the dollar. Such a development could further reduce the international importance of sterling in global finance. While predictions of a complete collapse of the pound are generally considered extreme and high speculative, there is little disagreement that a persistent loss of confidence could gradually reduce the currency's influence within the international monetary system. The broader lesson is clear. Reserve currencies are not just judged solely by history, they are judged continuously by investors, institutions, and governments around the world. If inflation remains elevated, if purchasing power continues to deteriorate, and if monetary policy fails to convince markets that price stability will be restored, confidence can slowly shift elsewhere. That is why the decision made by the Bank of England in the coming months may prove critical, not only for inflation and economic growth, but also for the long-term international standing of the British pound itself. For now, markets are watching closely. If inflation remains stubbornly high while the ECB continues tightening policy and other major economies respond more aggressively, the pressure on sterling could intensify significantly. In this scenario, preserving investors' confidence may be just as important as controlling inflation itself. And finally, in 2027, British pound could be forced to leave SDR, and euro, dollar, and yuan will get a bigger slice of the SDR basket.